Welcome back to another Earnings All-Star video. I'm Tracey Ryniec, Senior Stock Strategist here at Zacks. And we're in the middle of earnings season, but this is kind of a quiet week. So I wanted to switch gears a little bit and talk about what your strategy could be for this earnings season. This is Q1 earnings season, although we'll get a bit of the fiscal year reporters, but that's a couple of weeks from now. For now, these are all the first quarter. These reports won't really reflect the impact of the tariffs per se, because they didn't really go on until the second quarter began, unless you were in certain areas like steel and aluminum, and maybe a little bit of impact from the Mexico-Canada situation that was going on. But otherwise, the actual impact is still happening right now, so we won't have that. But we are waiting for these companies to tell us what it is they're seeing. And a couple of key areas to watch. What is the impact of any kind of tariff? We already have 10% on many, many countries, even if the reciprocals are paused. The 10% is still 10%. So that's going to impact. And then we're going to want to know what's going on with the consumer. So if it's a consumer name, are they pulling back? Are they, getting a little jittery? Or maybe they're not, because some of the reports we've got in just last week from the big banks who, have a good idea of what's going on with the consumer. They have credit cards, so they can see the spending. And they said they haven't really seen it pulling back even into March, when everybody thought that the consumer was getting jittery. Of course, it depends on what area you're in. If you're in apparel, for instance, the Wall Street Journal was just reporting that women are starting to pull back on the apparel, and they are 60% of that market. But how much will they do? Or is that it? Is the panic over and then they will resume spending? A lot depends on the job market, of course, and then what the actual impact is of the tariffs on pricing. But let's take a look at 5 companies reporting this week, what their earnings surprise looks like. But I'm also going to throw in there the price of consensus, because I think it matters for this earnings season. And this is part of our strategy as well. So the strategy has to be what is going on with those tariffs and what is happening with the consumer. And that is all mostly in the guidance and the conference calls. But let's take a look at 5 charts. Okay, the first one out of the gate is Abbott Labs. I chose a drug stock because they're about to be tariffed, apparently. And so I was kind of curious to see what was happening with these earnings estimates. But you can see nothing is happening so far. It's got very nice earnings growth. 2025 expected 10.3%, 2026 11.4% for Abbott, ticker ABT. That is very generous. PE, though, is very elevated. We had a surge in the stock here to start the year. It has come back off on some of these tariff threats, but still trading around 25 times. So not that cheap, but amazing earnings surprise track record. You could assume we're going to get another beat, but wait, this is just a meet last quarter. So it's always a little bit on the edge, but they've managed to do it. These are very small beats because we've got the small arrow. That's just a meet, but still green across the board, except this one miss in 2021, barely missed then. So great earnings surprise track record. It is an earnings all-star, but we don't really care so much about the meet or the meet, beat, or miss here. We care more about these lines, these price to consensus lines. But for now, the analysts are holding firm going into this report. So that's Abbott Labs, ABT. Then Taiwan Semi, this is going to be a big one, reporting, even though they do check in, so we kind of know what's going on. Great earnings surprise track record from Taiwan Semi as well. Just the one miss back here during the pandemic, and it was a small miss in 2020. Otherwise, last quarter, it beat by 3.7%. So it does have the great track record. Now, due to the AI revolution and just the demand for chips, it was soaring going into this year, but you can see, like a lot of the AI revolution stocks, it has pulled back considerably. What about earnings? You can see up and to the right is still going on. The analysts don't appear to be getting too bearish here, maybe a little bit for 2025. You can see a little bit of a decline there, but not much. 2025 earnings expected to be up 29%, 2026, 21%. It does have the Zacks number 4 sell. That could be because some of the estimates have fallen off going into this number, or let's look, I can't resist. Or maybe someone has cut in the last week, getting a little bit bearish here. And you can see the estimate for the full year is down to 908 from 915. But quarter still staying the same at 202 here. So they didn't lower the quarter. As you can see, nobody's lowered in the last 30 days there. But they have for the year. So that affects the rank. And that's how we're getting the number 4. So the 4, the sell, is just reflecting the bearishness here on this stock. But we don't really know what all is going on. And we're waiting for a tariff on the semiconductors. Apparently, that's still to come, and they aren't going to get an exemption of some sort. So all of these factors, this is going to be an iffy one to watch. I'm not even sure they can give guidance, but we'll see. So that's Taiwan Semi. TSM is the ticker. Then we do want to check in with the consumer. So I chose one of the credit card companies, American Express, to tell us what is going on, because this is a great way to know. And you can see right now, again, the analysts are pretty bullish here. You're not seeing any real cuts, maybe a little bit here in 2026, but not really. They're all waiting for the actual report to come out. 2025 earnings up 14.1%, 2026 14.8%. It has had a big drop off here as everybody's assuming recession, and then that just will decline the spending. So the shares are actually trading at 16.5 times right now. That's not too expensive compared to just a couple of months ago. But is that an overreaction? Is the sell-off overdone on American Express? We'll see. So far, the upper end, which is more of their market, has been holding up quite well. But a lot of people and the market here expecting that to break down ultimately, and it would in a recession, if we get a recession. So we'll see that, we'll see. It has a few more misses than some of the others, but it has strung together a nice earnings surprise track record last quarter. It barely beat, however, just 0.33. But these, we'll see. It's unclear what is going to happen here with the credit card companies and consumer spending. So that's American Express, AXP. Then I wanted to take a look at the job market. It's kind of rare for us to cover stuff going on in jobs, but we have talked about Manpower Group in the past, and you can see completely different chart than those we were just looking at. Let's start with the earnings surprises. It does have a good earnings surprise track record. Look at what was happening during the pandemic, and we had one of the best job markets ever, in the last 25 years in 2021. And then the Fed started tightening, job market really loosened there, and it's been downhill ever since. Now, I am kind of surprised. I haven't looked at this chart ahead of time, and I am surprised to see it trading at 5-year lows here. This is really pricing in a recession here, even globally, because Manpower Group does a lot in Europe as well. So you can really see it being priced in here. And the analysts are now pricing it in too. They've been cutting even as early as last year for 25 and 26. But you can really see it exploding here in 2025 and 2026 as we entered this year. So not surprised. Shares are down 12.9 times is what they're paying. what they're trading at. 2025 earnings expected to decline 13%. I am kind of curious just to see if anyone's been cutting. It is Zacks number 3. So that would tell me no. The last cut was 60 days ago. So one analyst really cut. And now, the estimate is just hanging out at these lower levels. But take a look here at the 90 days. So we're looking for 396 for this year now. It was at 519 just 90 days ago. That's kind of shocking. That's a pretty big and significant decline. Looking for a rebound next year back up to where it was supposed to be for this year. But this year, definitely pricing in some kind of recession here with Manpower Group. So Manpower Group, not surprising. Most people probably be staying out of this stock until there's some kind of clarity about what's going to happen with the job market. But the market is forward looking, so it's pricing it in. Manpower Group, MAN. And then we're going to wrap it up with a home builder. I can't stay away because we do want to know if people are still out there buying houses. We were thinking that the mortgage rates were going to come down this year as the Fed cuts those rates, which they started last year. So the mortgage rates did come back down into the 6s. But during this tariff situation, the treasury yields have spiked higher again, and that has pushed the mortgage rates, the 30-year fixed, back over 7%. So the home builders will see a virtual halt again when the rate goes back over 7. And now we have in the mix some worries about the jobs. Those are the two things which spur on home building is jobs and the mortgage rates, and both are not good here. So this will be interesting. We've been hearing mixed messages from the home builders. It hasn't been terrible going into some of these numbers, but they've had to cut price now and are heavily incentivized to get those buyers in the door. So what will the tariffs do to margins, though, with the home builders? A lot of their components come from outside the country. Remember, during the pandemic, when we had supply chain issues, there were things that were just missing for months, and it delayed a lot of the home building. And those things were, garage doors, remember, were delayed. And so there was just a shortage, and you can't close on the house until you got that garage door in. But this time, it might not be shortages. It might be higher prices for a lot of things. So what will that do to their margins? Even if sales rebound, look for earnings to decline with the home builders. And that's what we're seeing here on the chart. The earnings surprises isn't bad for D.R. Horton. Only 3 misses in the last 5 years, which is incredible considering all the pressures they were under with the supply chain during the pandemic years. But now pressures of the tariffs and possibly a recession, which do impact them. But last quarter, decent size beat here, 8.75 beat last quarter. But these estimates coming down pretty hard here now. For 2025, earnings expected to decline 10.8%. And then rebound, that's the tan line, by 11.7. But all these factors are in play now. So with the home builders, it's going to be quarter by quarter. Things are going to change as the tariff situation changes and obviously the job situation. But you can see here's the 10% decline expected for this year. And we do have one analyst cutting in the last week now, getting more bearish here going into this. And we're looking for the 1279 for the full year now. And like we've seen with Manpower, this is down from 1410 just 90 days ago. So the realities are hitting now of, just a slowdown in home building. We're going to see it in these earnings. These stocks are still cheap, but this is a bit of a value trap here now. So we've got a PE of 9.4 and a PEG of 0.5. but these are cyclical stocks and we're heading into the next part of the cycle. The perfect market conditions kind of for the home builders that we've experienced over the last 2 years, even with high mortgage rates. Yes, I would still consider it to be perfect market conditions because the existing home inventory was so low that they could still maintain their prices. And if you wanted to buy a house, you were in some markets limited only to the new builds, but that has changed. Many homes now on the market in very hot key markets like Texas and Florida and the Southeast. Inventory's building there. That means a lot of competition from everyone else who's selling, and that means price declines for the home builders. So they're adjusting to this new reality, and so are the analysts as we see them cutting here going into it. So I'm relatively bearish on the home builders for this earnings, but we are going to tune in to find out what is happening with the consumer, what is happening with the tariff side and their cost situation. We're going to be doing that with all the companies. That's why your strategy has to be a little different here this earnings season, I feel. It's not just about the beat and the miss. You could have a perfect earnings surprise track record and beat again, yet the stock may decline on this earnings season. So a lot of balls in the air, kind of reminds me of the pandemic. So you don't want to miss a single one of these episodes. I'm bringing you these videos every week. We are going to get Netflix this week. I didn't really want to cover them because it's not quite as vital to the things we're looking at, but it is on the consumer side. And we don't know if some countries might do some kind of reciprocal tariff, and tariff service side of things, which would be Netflix. But since nobody's doing that yet, we're staying off of that. But Netflix, first of these kind of big growthy names to report this week, in addition to Taiwan Semi, and then we will get the Mag 7 after that. So be sure to subscribe to get all of these videos. I'll have the Mag 7 for you next week and many other big names, but the earnings season will come into focus pretty quickly here. So we'll see this week what they're saying, or if they can even give us guidance. But these are key times. So subscribe at Zacks.com/YouTube to get all of our videos. I'll also be tweeting them out. So get them on my Twitter or X account or Blue Sky or on StockTwits. And until next week, I'll see you with some more earnings charts.